This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Dylan, let's sort of maybe break into what we want to talk about today.
Break the investment ice.
Yeah, let's break the ice. I want to do one episode at the front, which is going to be nothing like every other episode that we do, just on the basics. I get so many young people, so many parents, grandparents saying, how do I invest for kids? How do I get my kids started investing? What should they do? There's so much noise out there, so much information. I just wanted to give people the real bare bones basics, like how do you get some money? What do you do with it once you've got it? How do you make sure that you don't lose it?
And also for those people who, maybe going through a transition of wealth. So inheritance is a big, big topic. We're going to have this huge intergenerational wealth transfer over the next 20 or 30 years.
True.
A lot of people are going to be coming into money, perhaps for the first time. And these are the sort of basic principles that we want people to understand and use as maybe they invest for the first time or even the second or third time. They're good things to come back to.
Yeah, and look, it's really for the benefit for us doing this is that we don't have to cover these topics kind of all the time. Like this, you can just refer back to this app and know that everything we talk about is kind of like grounded here.
We'll reference it in future.
Maybe. Deal. Okay, so quickly, let's go 101 and talk about intention, goals, and why we bother trying to create a surplus and invest money in the first place, and why having goals and some sort of qualitative guidelines around what we're doing is really the cornerstone of everything we want to do here.
Yeah, absolutely. Well, first and foremost, it's crucial to have a clear objective, right? Like
in anything,
but particularly finance, right? It's a finance podcast, so we probably talk about finance objectives, probably first and foremost. But, beyond a generic desire for having more money, we want people to think about their investments and what they're putting their hard-earned money away for to have a bit of meaning. So that can be different for everyone, right? You might want to be creating a legacy. You might want, as you said before, you might want to be, building that nest egg for your kids to be able to buy their first house without the same stresses that a lot of people are going through with the first, building up their first deposit. It could be that you're managing a transition of wealth to prepare for the later stages in your life. A whole lot of reasons. But having that intention, that goal behind, it creates motivation, it creates desire, it creates that intention that means that your money doesn't have an issue, don't you think?
Yeah, I do. And I think that, having a goal that's not tied to just being richer or just generating higher rates of return also, helps you identify a risk profile. It helps you take the right amount of risk to achieve your goals. And it also helps you stay the course when things aren't going as well as you'd like them to do. And it also helps you course correct in those moments. So how do you get back on track essentially? Because you're inevitably going to get off track to some degree at some point in time.
At some point,
so
absolutely.
I think that having goals, having a North Star or a couple of North Stars is a pretty important part. Dill, can we talk quickly about surpluses? Because you can't have a goal and you can't get there without extra money beyond being able to somewhere to live and somewhere to eat, something to eat and somewhere to dress some clothes to put and put on your back.
Yeah, absolutely. I mean, so, second step, other than you've got your goal there, and then what you want to do is you want to create that surplus. So surplus comes in a couple of different ways. The sort of first thing that we want to do is maybe have that emergency fund or those liquid assets, right? So we see a lot of people who have a lot of money tied up in property, but if something hits the fan, a great example of that has been interest rate rises over the last 12 to 18 months, right? Like a lot of people are now at the point where they are struggling or feeling the pinch. Not necessarily
financial stress.
That's right, financial stress. So feeling the pinch, lots of people aren't necessarily, struggling to eat on a daily basis, but certainly feeling
Plenty of those too, but generally not listening to this podcast.
Absolutely. But because their wealth is tied up in non-liquid assets, they can't really do much about that. So we always encourage people to have a pool of liquid assets, whether that be cash, just an emergency fund in savings, or some of their portfolio sitting in things like stocks or, relatively short-term interest accumulating assets where they can access it in the event that something happens to them. The other area that we like to talk about is regular surplus of income. So human capital, right? Your work, your income, and what you're generating shouldn't be 100% allocated to things at every time. We want to have some level of flexibility there for two reasons. One, we want to be able to save and accumulate wealth. And the other one that we want to look at is thinking about how do we make sure we have the ability to do the things that make us happy. So, Luke, for example, when you're talking to your clients, they're taking their pools of capital. Generally speaking, you will have a large portion of that in liquid assets so that they can choose to do the things that they want to do, right?
Correct. And I think a lot of people underappreciate the importance of liquidity, whether that's from a wealth management sort of high net worth client perspective, or also younger people with less money who are still trying to build their wealth. Having the ability to sell for a fair market price, change without paying huge amounts of transaction fees, and then reinvest, which is what everyone kind of forgets about, the reinvestment risk, is really, really important. I think the ultimate reinvestment is, as you said, is in your human capital, your ability to add to your skills, add to your salary, add to your business earnings, and continually grow and reinvest over time. And we're looking for companies that can reinvest the capital that we give them at higher and higher rates of return over time. And I think as an individual, that should be your goal as well. That will help you best create a surplus over time. And just because you might not be able to do that today on your current wages or your current salary or with your business running the way it currently is, doesn't mean you're not reinvesting your surplus. It just means that surplus hasn't grown to a level yet that when it's coming out and you're seeing it in your bank balance. But certainly over time, we'd hope that does start to develop and you can start to grow. So as long as you've got some intention there, as long as you've got a bit of a plan in how you're going to continue to build a surplus over time, whether that's through savings, whether that's through reducing your spending, whether that is through earning more, one way or another, you need that surplus to be available to you so that you can protect in the event that something unfortunate or unlucky occurs, that you can invest for your future and for your future lifestyle. And further, you can hopefully and potentially help out others, whether that's philanthropy, your kids, your favourite neighbour, whatever. If you want to help me out, you feel free. The thing I just touched on, Dylan, and it's not an area of expertise for me, but I know that you're sort of all over it, is sort of that protecting against unlucky stuff occurring and insurance for people. I think that's kind of the third pillar of this basics episode. So just quickly talk to people about, okay, so they've got some surplus, they're working on their career, they're working hard at that, as hard as they can. They've got an emergency fund there for, incidentals, cars breaking down and that kind of, roof leaking. But it's pretty hard to save enough money to protect your partner in the event that you as the key income earner pass away, or that you do your ACL on a holiday picking up the kids out of the pool and now you can't work.
Yeah.
Give me the rundown.
So one of the things that we talk about a lot with clients is our income is actually an asset that we have throughout our entire life. And if you accumulate that income from your sort of working career start and maybe your early 20s all the way through to, the average retirement somewhere in your 60s, it is actually the biggest asset that you have your entire life. Now, we insure our cars, we insure our house for all these catastrophic events.
Important assets.
But a lot of people may not think about insuring their income. At the end of the day, your capacity to earn is what allows you to do those things that make you happy. It allows you to build the wealth and it allows you to make sure that you've got safety and security for your family. So things like income protection, disability insurances, life insurance, again, God forbid something happens to you like that, but statistically, these things happen. we talk about it as not just an insurance piece, but we actually talk about it as what are your financial goals? What are your financial outcomes that you're searching for? And how do we make sure that those are protected no matter what happens?
Correct. And I think that's just that, sometimes unlucky things occur. We can write the best plans in the world. We can, insulate you as best we can, but things are going to occur outside of that. So we need to protect against those things occurring, provided they're going to negatively impact where you want to go.
Yeah, and look, hopefully it's a complementary thing that allows you to live and invest and do things with a little bit more freedom because you don't have the worry and need to have such a safety net there. That might mean that you can grow your wealth to a point where you don't need insurance from sort of 50 onwards, right? Maybe 55 on whatever level of income you're sort of seeking for. But if you've got assets to that point that are going to be able to provide that, your premium is going to be much higher when you're 55 or 60 because your chances of being ill or having an accident are going to be much higher then. So, build wealth, but also protect the early stages because that's the most valuable. You've got the longest time horizon there for your income.
Sounds good, Dill.
Let me ask you this one.
Go on.
Right. What do we do when we start investing?
All right, I'm going to give you the Luke, real quick version of what you should do with investing.
Because you could talk about this for 17 hours.
We're going to talk about this for many, many, many hours on this podcast. But this is your bare bones basic. I'm starting with $1,000 or whatever, and you've saved some money, and you're sick of you want to generate better returns.
You could start with $1,000. You could start with $1 million. If it's your first time investing, you need to know this stuff.
Look, you need to have this as a baseline to compare everything else that goes on in the market. So let's just start. First off, get the right type of account. What you need is a HIN-based online discount brokerage account somewhere. If you don't want an advisor, that's probably your easiest bet. Get that, then you can get access to all the listed investments on the ASX, kind of at least. Then from there, you're going to need to go and buy a multi-asset, low-cost ETF from a Vanguard or a BlackRock or other, right? ETF provider out there. I'll leave you guys to do the product comparisons on your own, or we might do that on another episode. But it's one of those ones that's called conservative, balanced, growth, high growth. And it's kind of going to match up to your risk profile that you want to take. If you don't know what your risk profile is and you don't know which one to buy, you might need a financial advisor.
That's right. I mean, look, there's a lot of ways in which you can do this stuff yourself, obviously. And we might get to a point around this later on in this episode. But, the risk profiling tools are available online. Type in risk profile into Google, you'll get a 10-question, very simple questionnaire, and it'll give you a score. It's a really, really good indicator of sort of where you sit with your tolerance to risk, your tolerance to volatility, which is important. Volatility
It is important. But look, at the end of the day, there's lots of rules of thumb. There's lots of easy ways to do this, but the key thing here is not to get bogged down in it too much.
That's right.
Right? If you're a younger person, lean towards growth or high growth. If you're an older person, lean towards balanced and conservative. Pretty simple, right? Now, it doesn't apply to everybody, but on the whole. Okay, cool. So you've done that. You've bought your ETF. You set it up so that it's on dividend reinvestment because you don't need to. The asset allocation is occurring for you inside the multi-asset ETF.
Can you explain to us dividend reinvestment?
Okay, so every quarter or month or whatever, depends on the ETF. You're going to get what's called a distribution. So it's a company, so you can't they can't hold profits in the entity. They have to distribute them to the unit holders. You're a unit holder once you buy the security, and essentially those are just the earnings that are coming out of the company. They're a combination of capital gains and distributions that the fund receives, and they're paid out to you regularly, which is great.
That's right. So it's not dissimilar to owning Commonwealth Bank shares, right? Where if you were to buy a whole diverse range through a diversified ETF, you would own a small amount of each of those companies, and hopefully those companies are profitable on average. They will at least then pay either a distribution of their growth or their dividend, so their profits, in the same way that Commonwealth Bank shares might be expected to pay a regular dividend of
and
their
go
profits
up a little bit.
And maybe go up a little bit as well. Could be any stock,
yeah.
Right? But ideally, as a first-time investor, we probably don't want to be going out without advice picking individual stocks.
Look, don't pick stocks. There's product now that can do a perfectly good diversified portfolio. You shouldn't just own shares. you need to own bonds, you need to own other asset classes that aren't just equities and aren't just Australian equities and aren't just Australian equities inside the top 50. If you think that's a good diversified portfolio, you're wrong. So, the end. You go and buy one of those. Fantastic. I'll put links in the show notes. But reinvest your dividends. Then every time you save some money, buy more shares in the same security. It's not complicated.
Regular compounding is...
Regular contribution, regular compounding, distribute, reinvest all your dividends, buy one security, only do that, do nothing else, never change, the end. Nothing else you need to know.
There you go. All right. Well, it's...
$50,000 worth of HEX debt.
It's 11 o'clock. Should we just pack up then?
Pretty much pack it up. Dill, I'm touching on it now, but like, why is not breaching your investments thesis and your investment strategy and going off and doing hot tip over there and thematic ETF over there so important?
Okay, so, I mean, look, Luke made a really good point there, which was, just do one thing. Pick the thing that suits you, just do one thing. And it goes back to our original conversation around goals, right? So you got a goal, you've got an expected return over that period and you want to achieve X. If you think that you are able to, go and pick this stock here, go and chase a theme here. You read an article in the AFR this morning that said that, micro caps in biotech are going to take off in the next 6 months. Yeah, chances are that somebody else has already done that and made money off it and that you're chasing a waterfall, right? You're chasing a return that's already happened. And the even bigger chance, it's probably wrong. Right?
It might not be, but the point is that I think you've defined a strategy that is built around discipline and the things that are in your control, which is how much you can earn and how much you can save. So, that strategy might not be the highest returns that you can generate. It's not actually what I do for my clients, as a general comment, but it works. It's one of a number of things that work. There's lots of ways to skin this cat and to be a successful investor. The issue is that we're trying to define here in this sort of initial first episode, foundational episode, just a basic way to do it that everyone can do.
Behavior, right? Behavior makes millions. Because if you can stick and be disciplined in the same way that if you stick to a master's degree and become a high-profile lawyer at something, you're going to make stacks of money, right? So if you can stick to a strategy and just let it accumulate over time without worrying about what the ASX update that day is or what the market movements look like.
You can focus on doing what you do.
Absolutely.
Don't worry about your investments. They're sorted.
Allocate a small amount of capital each week or each month to that. Just let it tick along and have that 5-year milestone or have that 10-year milestone in place. You'll get there. No worries.
And if you don't, if you are getting distracted by other things, focus those efforts into the thing it is that you do to generate more from your human capital. Don't worry about your financial capital because a strategy like that's going to have it pretty much sorted for you. Or employ somebody like me, like DPG, to take that burden off you and let us do what we do really well and employ our human capital to help you. So the final part of this episode is it's a bit of a plug, shameless plug for advice.
Shameless plug. First episode, shameless plug.
But we genuinely believe in the value of financial advice, whether that's strategic advice, whether that's ongoing investment advice. We have, access to a larger suite of investments. We spend more time doing this stuff, and that's what makes us better at it. It's not because we're geniuses or because we're super smart and you are super dumb. No, it's not how it works. We're just, it's just what we spend our time doing and what we spend our time learning and getting good at. So, the final part of this is if you are thinking about getting advice, you do want to come have a meeting with us, whether it's me, Dill, both of us together. We do that for clients too. We are more than happy to do that. We think that there is significant value to be added above and beyond running a simple strategy like I've just explained, which is totally fine. Not saying
it's a great way to get started.
Great way to get started, but you don't know what you don't know. There is a lot more that we can be doing for you. There's a lot more that we do for clients. I run a moderately successful business. Dylan is a multi-millionaire and makes squillions of dollars.
That's not true.
And so, we'd be more than willing to help you wherever you are in the country and whatever your stage in life. And if, we can't help you, we can almost certainly put you in the right direction.
At the end of the day, you're working incredibly hard for the money that you make, and you want to make sure that you're making the right decisions for yourself, your family, your future with that money. I'm not going to go and recommend myself a particular antibiotic when I'm sick, or I'm not going to represent myself in court in a legal case because I don't know how to do that.
I'm not even going to change my own light globes at home. I get Claire to do that for me. So yeah.
But do the things that you're great at, right? And excel in them, and spend your time wisely. Don't try and do 100 different things. Be, a master in one, and not a master of none.
A master in one.
I don't know. There's a
jack of all trades, master of none is the one.
Yeah, that's the one.
Is the trying to run it? Yeah,
that's right.
We like specialisation. We like niche, and we think it pays. So look, that's it. 25 minutes. Bang it out. That's the basics of how to get started investing, how to maybe invest for grandkids or kids, how to invest if you've got a relatively small amount of money and you just want to cover off the basics. There's literally nothing else you need to know.
Absolutely. We'll put up a couple of things in the show notes.
Yeah, there'll be some links and some money smart stuff and blah, blah, blah. But, so read all that. It's all good, all important, all useful. And if you have any questions, feel free to email us. You can email myself, Luke L at senecafs.com.au, or Dylan
at boldwealth.com.au.
Let's call it there.
Thanks for joining us on the first episode of our podcast.
There's going to be more, provided someone actually downloads this.
Stay tuned.
Yeah,
basically.
We'll see.
Like, subscribe.
Like and subscribe. And like I said, any questions, feel free to reach out.
Let's go get a coffee.
Thanks, mate. Chat soon.
Bye.